Wonderful. Let's start this from the beginning. All right, we're going to set our business up for permanent profitability today. Excited to talk you through this. Sales less profit equals expenses. So that's the big thing that we're talking about. It's not sales less expenses equals profit. That's the old way of doing things. And the new way of doing things is setting ourselves up for permanent profitability by determining what that profitability is going to feel like, look like, and touch. And so that what's remaining is what we're going to use for our expenses. I feel uniquely qualified to talk about this because I've been in business for many years, since 2007. And when I started my business, I was very good at doing sales and marketing. That was my specialty. So I was able to build my business up very quickly. By 2013, I had a team of 5 employees, and I was working on helping people with their bookkeeping and personal financial needs. It was great. Outside of the fact that I was going to every 8 a.m. networking meeting and 5 p.m. cocktail hour, I was working constantly. I was never seeing my 3 little babies at home, and I was completely exhausted. I was completely exhausted from the perspective of bringing in and managing the new clients and my staff, as well as from the perspective of my cash flow. I couldn't understand why it wasn't coming together for me, because I really was doing things what I thought to be very well. But what I was experiencing was that there was never enough money left over to pay myself as the owner. And there wasn't sometimes just not, frankly, not enough money to pay the staff too. So I remember one day in 2013 where I went to run payroll and there was not enough in the account to pay myself. So I said, okay, that's okay. I can forego myself. And then I ran the payroll for everybody else, and I was $34 and change short. So I overdrafted my account. One overdraft goes to the next overdraft. Couldn't quite figure out how to do things, couldn't quite get my arms around the profitability piece of it. I was so frustrated because I was working so hard. It was nonstop work, right? And so I thought, this has got to be a low point for me. You know what I can do to improve matters here? I can get myself a business partner who's going to bring cash into the business. So that's what I did. I got myself a business partner who did bring cash into the business, but that's not really a good reason to bring somebody into the business. You have to have certain, characteristics to work together and be able to feed off of each other. And while she was a lovely woman, we have very different personalities, and that didn't work for me either. So bringing her in as a position of needing cash in the business wasn't the solution. So after only a year of being in business partnership, there was a business divorce, and that can be very messy. And by this time, I was just completely fed up and exhausted and at my low point in business. So that's when I really did step back from the business. I went back to being a solo entrepreneur and handling only the business that I could. So I went about doing that for most of 2014 and 2015. By 2016, my phone was organically ringing. And because I am a salesperson and truly an entrepreneur at heart, I love that part of being a business owner. I was answering those calls and feeling like I needed to grow the business again. And I thought, you know what? After 2 years of being a solo entrepreneur, I can do this smarter the next time around. So I did. I started to grow. I started to add staff back into my business. We were doing good for profitability, but it was very small focus because it was just me full-time, one other part-time employee. And I did well enough so that I saved up enough money to head off to the Atlantis in the Bahamas, where they were having a business conference for Scaling New Heights, which is famous in my industry. And of course, I went there because it was at the Atlantis, and I wanted to, go on the water slide with the sharks and all of that. So I headed off went to this fabulous business conference. I heard this fabulous speaker named Mike Michalowicz, and he taught us about profit first and how to set your business up for permanent profitability. And I was on fire. I was completely on fire. I went back, I joined Profit First Professionals. I started implementing Profit First in my business, and that's been 4 years. So right at the end of 2016, 2017, I started implementing Profit First in my business. You'll hear the number results of that later. It has been phenomenal. Best thing I've ever done for my business. So what Profit First is all about is setting yourself up so that you understand what you want in profit before expenses. And the statistic that I like to share with folks is that the Small Business Administration did a survey of business owners who had under $25 million in annual revenues. And what they found is that 83% of those businesses were living check to check, while only 17% of them could live beyond that one receivable, right? So that's a terrifying thought. And I wanted to share with you what you think, what it's like to survive check to check. So it means that we are literally waiting for our client's check to come in before we can pay our own bills, right? We're waiting to receive that money. It means we're not going to have enough money in the bank to make your company's next payroll, which I experienced. You're possibly giving up your own pay in lieu of paying your staff or your team members. You're looking at bank overdrafts and poor borrowing choices. Credit card interest rates can run anywhere from 15 to 25%, and you're paying 25% on every transaction if you're using a credit card. So these are horrible things to have to go through, and it can be so extremely difficult to make a profit in business when you've got a 25% interest rate credit card with which you're funding the business. So that being said, I want all of us to commit to being 17%ers, right? 83% of the businesses out there are struggling to get past this check to check survival. I want us to commit to being a 17%er. And so we're going to do that through Profit First by prioritizing profit over expenses. So let's get to that and see how we would do it. Okay, there's 4 main components of Profit First, and they have a lot to do with the way we think about dieting in the dieting industry. So we're going to be covering these 4 rules of Profit First. The first one is about small plates. The next one is about eating your veggies first. The third one is about removing temptation. And the fourth is about developing a frequency and a rhythm in your business, or in dieting, it's about exercising regularly and keeping track of all that. So the first one is small plates, portion control. So we do this in Profit First by setting up multiple bank accounts in our business. And each of those bank accounts have a purpose. And by that, we're able to have portion control. Okay, so if we want to think about different bank accounts to set up in our business, first of all, your serving tray is your income account. Everything should come into the income account. All money that is collected in the business, whether somebody paid you from PayPal or paid you by credit card or paid you by a check or handed you a wad of cash, all of that gets deposited into one account, right? That's your income account. And from there, we're going to divide it up, that income, into portions, into smaller portions. So the 4 portions that we would divide it up, or the 4 bank accounts that we would need outside of the income account, is the profit account, the owner's pay account, the tax account, and the operating account. And notice the order that those are in, and they're in that order for a reason: profit, owner's pay, and tax. These 3 things are things that serve the business owner. It's hard being an entrepreneur. It's a dangerous game. 50% of businesses go out within the first 3 years. So if we are going to manage to stay in business and make it past those statistics, then we have to be sure that we understand the job for each of those accounts and how we as owners benefit. So we can, as an owner, benefit from the profitability of the firm. Owner's pay is how we pay ourselves in the business. And I'm not talking about juicy vacations to the Bahamas. What I'm talking about is, let's put food in the refrigerator, let's put shoes on our feet, let's put a roof over our head. We're talking about the things that we need to live on a day-to-day basis, okay? And then tax is a very important thing. And people, roll up their nose and think yuck when we think of tax. And I agree, I don't want to pay any more tax than I should. But on the flip side, if my business is not profitable, I have no tax burden. Okay. And I don't want that either, because I want to make money. How am I going to get the juicy vacations and the fancy car that I want if I don't have profitability? Okay. So tax is a privilege to pay. It's just one that we don't want to be surprised by. We don't want to be surprised by our tax bill. So it is something that does support the business owner. So profit, owner's pay, and tax, those three things always support the business owner. Operating expenses are the things that we need to run our business. It's our rent if we have an outside location. It's the paper in our printer, and it's the advertising and marketing costs that we engage to find our clients and to reach our clients. Okay, those are some examples of our operating expenses. There's an important thing we haven't quite talked about, and that's real revenue. So real revenue is different than total revenue, in that there are certain expenses in our business that are directly related to the products and services that we provide. Okay, so in my case, I provide bookkeeping service to a lot of small businesses. So when I pay my bookkeepers, that is contingent upon receiving that money from the client, right? And if I'm paying somebody hourly to perform bookkeeping service and I don't have any business for them today, that means I don't have to incur the expense for paying them, right? So we can think of it as a dog walker business. Okay, so you've got a person who owns a dog walking business. And every time somebody goes out and walks a dog on behalf of the business owner, they get paid a fee for walking that dog. Okay, so the fees that the dog walker has been paid, that's the materials and contractors. If the owner did all the dog walking themselves, then there's been no material and contractor expense incurred, right? So everything would be real revenue in that case. So if you are working as a solo entrepreneur and you're responsible for all the operational expenses in your business, or all the operational jobs, should I say, in your business, and all the client deliverables, then you have no materials and contractors expense. But if you are paying people, other team members on your behalf to provide client deliverables, and it's not a fixed cost, then that is going to be a materials and contractors expense. Okay, so the way it goes is that we have total revenue up here. That's that income account. Everything is coming into that income account in your business, in the bank accounts situation, less the materials and contractors. And then that's going to be equal to your real revenue. Okay, so real revenue is where everything else starts. Those other expenses, profit, owner's pay, tax, and operating expenses, all of that has to come out of real revenue. So if I have a dog walking business again, and I earned $100,000 in dog walking in 2020, and I spent $999,999 of it to pay the dog walkers, that means I have $1 left in real revenue. And that $1 has to be split up between me in owner's pay, profit, tax, and operational expenses. Nothing else can be paid until the materials and contractors can be paid. So as it works in profit first, then we have our real revenue at the top. And then the next thing we're going to do using that dieting example is we're going to eat our veggies first. We're going to allocate to these other accounts. So we take the real revenue that's left at the top, and then we divide it by percentage into the profit account, into the operations account, into the tax account, and into your owner's pay account. Okay, so it gets divided into these individual accounts. All right, so a lot of times you can go to a professional association and get an idea of what percentages are appropriate for your industry. It might be different from industry between industries. But if you do not have a professional association, or you do not fit into that widget, into that industry association model, you can use these target allocation percentages. So what we're saying is that Mike and Profit First, they've gone around and they've surveyed and surveyed and surveyed small business owners. And we have found that if your real revenue falls into these different revenue ranges, columns A, B, C, D, E, and F, that we can expect that our allocation percentages are going to be similar to this. So we're going to do an example here. And if you want to throw out any examples, we can do that as well. But my example is a firm that does web design and programming. And in 2020, the annual revenue of that web design firm was $600,000. Okay, so we have a $600,000 firm. And that web design company then had a team of 5 people working in it during 2020. Of the 5 people, one was the owner. Okay, there's one owner in this business. There is one employee that's on payroll. The person on payroll is an office manager. That office manager gets paid a salary of $50,000 per year. So that's an employee job. They manage the office. The payroll comes out every couple of weeks, and payroll taxes are subtracted from it. There's a team of 5 in this web design business. The other 3 are web programmers and designers. Those 3 web programmers and designers are subcontractors. They're not employees of the business. They are subcontracted for the business. So that's our 5 employees. Again, we have $600,000 in this business of total revenue. Each of those 3 subcontracted web programmers and designers are making around $70,000 per year each. So there's 3 of them. So 3 times 70,000, $210,000. So if we have $600,000 of total revenue, we have the 5 people working in the business. What I want to know is how much is our real revenue for this business. So again, the 5 people working in the business are the owner, the operations manager, who's an employee at a $50,000 a year salary. And then you've got those 3 contracted web programmers and designers, each at $70,000. So that's a $210,000 expense for the business. So how much do we have left for the real revenue? Okay. No volunteers. I don't see anybody chatting. 600 minus 210,000. That's how much we've paid for those 3 web programmers and designers. We have $390,000 remaining of real revenue. Okay, from real revenue, what we're going to do then, 390,000. So that's not column A here, it's column B, right? If our business has a real revenue range of between 250,000 and 500,000, then we can anticipate that we're going to be working our business off of these percentages. So again, my real revenue in this firm, the web design firm, is 390,000. So that means I'm going to have a profit account and I'm going to put 10% of 390,000 or $39,000 over the course of the year. I am going to be transferring money as it comes into the business into the profit account. 39,000 of it will end up in the profit account if I manage to stay at 10% throughout the year. Okay. And then owner's pay, again, owner's pay, that's what we live off of, right? That's to put food on our table and shoes on our feet and a roof over our head. We're going to pay ourselves as owner 35% of the 390,000, which is 136,500. So if you manage to bring in 600,000 in revenue, then you should also be able to manage to pay yourself 136,500. Some people will say that's a great living. Some people will say that sucks, Angie. I want to make a lot more than that. But that's what the business can afford. That's what a $600,000 business can afford, is it can afford to pay its owner about 136,500 based on that real revenue of 390,000. Not based on the 600,000. I said that incorrectly. It's really based on that 390,000 of real revenue. If you have 390,000 of real revenue, the owner can afford to take about 136,500 of that and pay themselves with that money. And then they want to save 15% for taxes. So 15% of 390,000 is 58,500. And 40% for operational expenses, $156,000. So if we take the $390,000 of total of real revenue, and we add together the 10% of profit at 39,000 plus the 35% of owner's pay at 136,500 plus the 15% of taxes, which is 58,500, plus the 40% of OpEx, 156,000, we're going to be back to that total $390,000 of real revenue. And then I just want to go back. Now, we said at the beginning, this is a team of 5 people that are delivering this $600,000 worth of total revenue in web design and web development. Okay. The owner, we now know, is getting paid $136,500 for their efforts. We know that the 3 subcontractors, they came out of materials and contractors to the tune of $210,000 in 2020. And I just want to go back to the one employee who is the office manager. The responsibilities of the office manager go across the whole organization. So they have multiple clients. The office manager might do a little work for one of the clients, might keep the books for the business, might pay some bills, make some deposits, a little bit of everything, right? It's a plethora of different things that they're responsible for. That pay for the office manager who's making $50,000 should come out of the operating expenses. So we had 40% of real revenue set aside. That's 156,000, and we're paying our office manager 50,000. So we still have 106,000 left over for the other operational expenses in the business. Okay. So that is the way, the second rule of dividing our expenses into veggies first works. And then the third rule is to remove temptation. So what we want to remember is that if we're on a diet, we don't want to keep cookies and candy and potato chips in our house. We want to leave those at the grocery store and only keep the healthy stuff in our house so that we don't have that temptation. And this also works in terms of small business and profitability. If we make it difficult for ourselves to spend certain pieces of money, we have removed temptation. So what I see happen time and time again is people spend what should be their profits on an extra dues and subscriptions, on an extra advertising campaign, on a fun new business coach. They're overspending on those things because they have not removed the temptation. And by removing the temptation, I mean that that income account where all the income is coming into is also the same place that they're paying the plumber and they're paying for their rent and they're paying for their office supplies. All of it's coming out of one account. So by taking it out of the income account and moving it into, say, a profit account, then we know, oh, I cannot use that money in my profit account to pay for that new subscription service that I want to. Okay, that money's set aside for other purposes. It has a different purpose. Okay, so I think, yep, okay. The fourth rule then is to set yourself up with a frequency, right? We want to be able to implement a rhythm, and we don't want to have to think about it because we don't work on complex thoughts. We work on things that happen over and over again. That's when we handle ourselves the best. If we can create new habits, new actions that don't require us to think so hard, it's much easier to maintain those. So in the dieting perspective, frequency is related to exercise, right? Making sure that we get our exercise in. And it's also related to making sure we kind of know what we're going to be eating. And so we're not all of a sudden starving and we need to go to Chick-fil-A or Portillo's and get some yummy drive-through food. You know, it's removing that temptation. It's setting ourselves up for frequency. We know that every day we have a salad for lunch and that's what works for us, right? Okay, so when we think about this in terms of profit first, it means that we're implementing a rhythm, okay? And that rhythm is that all that income is coming into your top bank account, your income account, and then I'm going to allocate it into the other accounts by percentage based on my business historically and what I'm trying to achieve. I will distribute it into those other accounts. And then from those other accounts, I'm going to pay my bills appropriately. So Angie, as the owner, is going to be paid from the owner's pay account. And my office manager is going to be paid from my operational expense account. That way I'm spending it from the right account. So we do that on a 10th and 25th basis. And that means the 10th day of the month, the 25th day of the month. And those are just random dates that we've chosen because for most small businesses and really in our personal lives too, we see that we're usually paying bills about twice a month, right? We're having to take a look at our cash flows about twice a month and making sure that everybody gets paid. So what we do is we collect the income throughout the month in that income account. And then around the 10th and around the 25th of the month, we have this total amount of income that's sitting there and we're going to distribute it into the other accounts by percentage. Okay, so that's the way we do it. And that's typically enough for things like owner's pay and for operations expense, where those expenses are coming out with a greater frequency than is paying your taxes, than is looking at profitability. So what happens in Profit First is we allocate every 2 weeks around the 10th and the 25th of the month. But then once a quarter, we do a quarterly profit distribution. So we have let that money sit in the profit account all quarter and it's building and building and building. And then at the end of the quarter, we can transfer it out. And if you're willing to get started on Profit First, what I encourage you to do is go to the bank and get all these darn bank accounts set up and start allocating one day at a time and making those transfers. And by the time you get to the end of the first quarter, you should have a nice little pot of money there for you. And this is your extravagant goal. This is your fun money, your joy money. I'm not spending it on anything boring money. Okay. So we're going to go, I want the new designer purse. Oh, I want the vacation to Europe. I want the sports car, whatever it is. That's the money that you are saving towards that big, delightful, juicy goal. We can do that the first quarter. And then we might get the guilties because we've done things in the past, maybe not as well as we should have. So the second quarter, the third quarter, the fourth quarter, you can put it towards other debts. You can put it towards paying down a line of credit. You can put it towards hiring a new employee. That profit distribution in future quarters can be used towards things that you want to do in the business that you're not quite sure you can afford yet. But the first time around, it's only for you. And I have seen fabulous first quarter profit distributions. Now, not everybody gets a fabulous first quarter profit distribution. You might just save yourselves enough for a really nice trip to Starbucks. But you know what? You've declared your profitability. You are going to be permanently profitable from here out. So when you go to Starbucks that day, you're going to get the one with the extra foam and the extra syrup and just blow up your sensory system. And you're going to have a little party and do a little dance, right? Because that is your coffee to enjoy for changing your habits. Okay, so that's what we do with our quarterly profit distributions. Taxes typically work the same way, where we might be making quarterly estimated tax payments. We might have to pay our tax provider, our CPA, for filing taxes once a year. We don't necessarily need to access the tax money on a twice a month basis. We can usually do that once a quarter. And then the other thing that we do once a quarter, completing that frequency and that rhythm, is to set up our current allocation percentages. So all quarter long, you've been at 1%. Say your operational expenses is hovering at 58%. And over the course of the quarter, you've managed to cut back a couple subscriptions, and you've managed to change your insurance provider and lower a couple of different costs. So now you no longer need 58% in your operations expense. You could go down to 55%. So you do that on a quarterly change. Okay. And what happens when you move from 58 to 55% is you freed up 3% in some other area. So maybe you want to give yourself an owner's pay 3% raise, or maybe you want to give the profit account a 3% raise. But whatever you choose to do, that's kind of a quarterly reallocation. And I will just say, for most people, we don't start out at those beautiful percentages that were on my chart a couple of charts ago. We start out, maybe not even being profitable, and we have a negative 100% based on the way we've been spending money. So maybe it's just about having a place for every dollar and getting to a point of zero profitability instead of operating at a loss. So that being said, it's just important to remember that it can take typically 18 to 24 months to roll out profit first in your business, and to keep changing those allocation percentages to get to your optimum level of profitability. And your optimum level of profitability does change as your business needs change. So it would be something, if you're committed to profit first, you would continue for the rest of your business life to reallocate on a quarter and to make sure that you are operating at the optimum efficiency. So this is about enforcing that rhythm. Again, we said the 10th and the 25th. If you keep doing this every month, it eventually works out, right? And it can be scary. I know from my own experience, when I was operating at a loss, I was terrified to start Profit First, but I was also overwhelmed with excitement because I knew this was going to be the thing that changed the business. If you're feeling that fear, that terror, don't worry. You're normal. You're absolutely normal, and it will pass because you are declaring your permanent profitability and you're setting yourself up from today to be permanently profitable. So what I would say about that is no matter what, remember that you're good enough, you're smart enough, and God, doggone it, people like you, okay? So just go for it. Even if it's not perfect today, you are constantly working and improving one day at a time, one allocation at a time to get to your optimal percentages. And the first thing you can do if you are operating at a loss is to get your butt to the bank, okay? You're gonna drive yourself to the bank and you are gonna open that first income account. That's the absolute most important account. And the second most important account is that profit account. Because even if you are not profitable today, you are drawing that line in the sand. You are declaring permanent profitability. And from this day forward, what you are going to do is for every income that you get, you're going to drip 1% into that account. Now, maybe we can't start with 10% or 20% or 30%, but we can all start with 1%. That will give us just that little bit extra breathing room to begin the journey of permanent profitability. And we'll get used to 1%. We'll make some cuts on how we spend our money, and then we're going to be able to up it to 2%, then 3%, and over time, you'll get to your optimal allocation. So it's very exciting to make that trip to the bank, and it's really not that much skin off your back, right? So when we get to the bank, we're going to open the income checking account. We're going to open the profit checking account, owner's pay, tax, and OPEX checking accounts. I haven't talked about this yet, but then I would prefer that you drive yourself to an inconvenient bank across town that's a pain in the rear to get to and open 2 savings accounts. And those 2 savings accounts are going to be for profit and they're going to be for taxes because, again, we don't use those every day. So out of sight, out of mind. Okay. So we're always going to be taking our profit first. So now this starts to make more sense when we say sales less profit equals expenses. Because, generally accepted accounting principles, GAAP, has always told us that it's sales less expenses equals profit. Well, we're deciding when there's going to be an expense in profit first. And so that's why we can flip it. So we're focusing on what comes first. And what comes first is us, because we've taken a big risk starting a business on our own. Okay? So given that, I just want to introduce the Parkinson's law. If you're not familiar with it, it's that our demand expands to meet the supply. And that applies to our small businesses, and it applies to a tube of toothpaste. So I will just say how it works with a tube of toothpaste. You pull that tube of toothpaste out from your medicine cabinet, and when it's brand new and fresh, you slather a whole bunch of it on your toothbrush and you go ahead and brush your teeth. As time passes, every day you're brushing your teeth a couple times a day, there's less and less toothpaste in that tube. It gets emptier and emptier. When it's emptier towards the end, we work a little harder to get the toothpaste out before we crack open that new tube of toothpaste, right? And that in itself is the act of Parkinson's law, because we're going to work to squeeze every last drop of toothpaste out of that tube. Now, one would say that our teeth are no cleaner on that first day with the tube of toothpaste than they are on that last day with the tube of toothpaste when there's maybe a little bit less toothpaste on there. Our teeth still got cleaned, right? And that same thing applies to small business in terms of the bank accounts, right? When we look at this big juicy bank account, we have only one bank account operational in our business and everything goes into there, all income and all expenses go out of there. We think we can afford things that possibly we cannot afford, right? because all the money's there and we forget, oh, that we have to pay the phone bill with that. Oh, we have to pay the rent with that. Oh yeah, I forgot about this. Okay. But when we have these multiple accounts and they have a purpose and we've named them that, it's the same thing. We're pulling out our smartphones. We're hitting the app to look at our bank. We're seeing the operations account has X amount of money in it. That expense would be an operations expense. We can decide right then and there if we have enough money to make that purchase or not. So bank balance accounting now works, and we are leveraging that behavior instead of fighting it. So we are building our habits, and building our habits builds our strength. Okay, so I have talked a lot. I am close to the end. I'm ready for questions. Can anybody give me an example of something that they're wondering if it should go into materials and contractors or not?
Yes.
All right, Rome, what do you got?
All right. So, as we are like interior landscape design firm, we do a lot of sales of products.
You do a lot of, I'm sorry?
Sales of products. So we resell furniture, plants, all the kind of products. That cost of goods go under the materials and subcontractors to find out about the real revenue.
Yeah, so you are buying it at one price and selling it to the customer at a different price.
Yes.
Yes, so that is your materials cost.
Okay.
Has nothing to do with operations. You would not experience that cost if you had not sold that couch.
True. Cool. Thank you.
Does anybody have any other gray areas for them? Okay. I will go ahead with what we are offering in hopes of supporting this repetition becomes habit. A lot of people do get confused when they start to go through their profit and loss and balance sheet and what's my percentage and all this kind of stuff. So that what we are offering is to do a free instant profit assessment, or actually you have to do the free instant assessment. You have to line up your income and your expenses, and then you can review it with me for free. Okay, so I am offering a 20-minute session to include going over the percentages that you've come up with and answering any gray areas for you as far as what you think your percentages should be. So I encourage you to do that. You can take the instant assessment, and then there's a scheduling link there, and we have some times reserved for you to click and schedule a time with me to go over what your instant assessment is telling you. Okay. We also have a group coaching program that's going to be kicking off on March 23rd. It is our third time through the program. And what we are doing is we are marrying the concepts of good compliance, financial practices, GAAP accounting, all of those things that are important to the IRS and important to your CPA, with marrying the concepts of profit first and what's important to you in trying to be profitable as a small business. Okay, so we marry those two concepts over a 10-week coaching course. We do go through QuickBooks Online. We are QuickBooks Online experts. We have advanced pro advisors on staff. So if you are a professional services based firm selling knowledge in exchange for money, and you're usually within the first 3 years of business trying to get this business off the ground, and you're low on funds in that you don't necessarily have the money, you can't afford to hire a bookkeeper in the business now, and you really need to understand how to do those books yourselves, then this program is for you. We're going to give you the basics of QuickBooks Online. And again, we're going to be marrying it with those concepts of profitability. So it's a 10-week group coaching course, and it starts on March 23rd. Okay. And I think that is it. Let's see here. Yes, so here's email, website, LinkedIn, Facebook. That's where we're active. We'd love to connect with you. We are here to help you be permanently profitable, to be the hero in your own story. We are our best versions of ourselves when there's no fear and there's no anxiety. And one of the major causes of fear and anxiety in our lives is money troubles, right? So we want you to be profitable, and we want you to declare your profitability today. All right. Thank you, everybody, for joining.
Thank you, Angie.
Thank you, Angie. Great presentation.
Thank you, Melissa.
Thank you. Bye.
Have a good day.